100% mortgages. Hey, they're back. So the big news is, for the first time in almost 15 years, it's possible to get a 100% mortgage. Possible, but not necessarily easy. Stick around and find out what's behind this big news. Hi, Kevin Wright back here with another property finance video. And we've got something hot to talk about this week. It's the return, for the first time in probably 15 years, return of the 100% mortgage. It's been pretty divisive because there's both negative and positive comment. And I have to say, there's merit in both arguments. So what's the news here? Well, Skipton Building Society has stuck their head above the parapet and said, hey, we're going to provide 100% of purchase price, no deposit mortgage. Now, it's got several caveats, and all of those caveats probably haven't been ironed out yet. Now, it's been termed the good conduct mortgage. In other words, potential applicant has got to have the squeakiest of squeaky clean credit history, and they've got to show and prove as a tenant that they've got a blemish-free rental payment history for at least the last 12 months. Now, Skipton are saying, and we're not quite sure of the detail yet, but Skipton are saying that they will look at the rental payments the tenant has been making and use that as a benchmark on the mortgage payments that that particular tenant can afford. Now, similar income multiples are still going to be at play. They're not chucking that away. But it looks like they're going to have a greater flexibility that has been employed by lenders across the board for at least the last decade, where you've got strict multiples of income and affordability models, which are based on lifestyle expenditure, that have led mortgage lenders to say, in a lot of cases, we're not going to give you a mortgage of the level you want, even though you can demonstrate that you've been paying more than that level of mortgage as your monthly rental commitment right now. In fact, it's a common gripe of reluctant tenants, would-be homeowners. Look, I've been paying this much rent a month, so clearly I would be able to afford that on a mortgage because I can afford it on a rent. And there's a plausibility to that argument. Now, counterbalancing that, we've got the FCA who police mortgage lenders, and they're leaning very heavily on them about this ethos of responsible lending. And this has been the ethos in place since the credit crunch of 2008-9. So since then, the FCA have leaned very heavily on mortgage lenders not to be too extravagant with mortgage lending. And that's where we find ourselves in the situation that we are now. The tenants with perfectly good payment records are unable to get a mortgage of a suitable amount to make that leap from reluctant tenant to aspiring homeowner. Now, desire to buy your own property, I don't think is as strong as it was in previous generations. There are generations now that actually celebrate the flexibility that not owning a property can bring them in terms of where they can live in the country or even in the world, and the types of jobs we do. We've got the concept of the laptop nomad. But for that core of people that rent, but would rather not rent, but would rather own, there's a swathe of them that have been prevented to doing so by mortgage lenders' criteria, foisted on them by the FCA. So why in some quarters has this been received and interpreted as a negative thing that could blow up into a huge problem? Well, I think it's a fear of returning to pre-credit crunch lending conditions. Now, as someone who was arranging mortgages in that time frame, I can tell you it was pretty much like the Wild West. You know, at some of the brokers' conventions I was going to in the early 2000s, it was a common joke said in pretty much in jest really, but look, hey, we can get anyone a mortgage as long as they've got a pulse. And it wasn't too far from the truth. I mean, you had self-certification mortgages where you could just tell the mortgage lender how much you earned and they wouldn't check it. You had heavy adverse credit. So even people with county court judgments, defaults on loans, were still able to borrow money, even though their credit history suggests they weren't very good at handling money, and they were probably going to default on that mortgage like they defaulted on their other loans. Still, those people got mortgages. And you had a number of lenders at the time doing 100% mortgages. In other words, the borrower could put down no deposit and borrow all of the money. And the pinnacle of that was Northern Rock. Do you remember them? Northern Rock. Now they did you 125% mortgage. Unbelievable, but true. So that was a 100% mortgage against the purchase price of your property, plus another 25% as an unsecured loan to allow you to buy furniture or whatever it else you wanted to do, or probably do some refurb on the property. Now, if you remember that far back, it all ended spectacularly badly. Now, the FCA stepped in the aftermath and said, never again. We're never going to run such a loose ship that all this stuff happens. So, self-cert mortgages, history, they were gone. Heavy adverse credit, gone. 100% mortgages, gone. And a whole new way of lending, interest only, main residence mortgages, not 100% gone, but much more curtailed and much harder to get. And at that time, just after the credit crunch, the FCA instigated probably the biggest upheaval in mortgage lending for decades. So a tightening of criteria in every aspect was going on. What was lent, who it was lent to, how it was lent, was all reviewed and reconfigured under the overarching responsible lending. And in those last 14, 15 years, mortgage lenders have received regular visits from FCA inspectors randomly going through their books to check that they weren't lending irresponsibly, and with a severe rap over the knuckles if they were. So there's a one view that says, oh, it's the thin end of the wedge. All the stuff from 15 plus years ago is coming back. This is just the start of it. I'm not so convinced that's the case. But of course, only time will tell. Now, what Skipton are saying is, as I understand it, that the combination of high energy bills and higher monthly rental payments, because they've been on the rise as well, often as a domino effect to mortgage rates going up in the last 6 to 9 months, causing landlords to have to put rent up. Now, primarily those two things have squeezed incomes to the point where an ever bigger percentage of someone's take-home pay is going on paying the rent and making it harder than ever to save a deposit. Now, some people have got guarantors who can stand good the mortgage for them, but not everyone has. And Skipton is saying, well, we're looking to help those people that haven't got that option of guarantor mortgages. Now, it seems that they're going to tightly control the availability of this so that it doesn't run away with them and become a big problem with non-paying borrowers. Now, of course, how that plays out remains to be seen. But I certainly think there are some merits in catering to responsible tenants that have got their life under control but want a bit more stability in their lives by owning their own property. Now, another warning factor that people are saying is negative equity. If you've got no stake in the property and property prices drop, then the spectre of negative equity, in other words, you owe more than the value of your property, that looms large. But look, that wouldn't be the first time in history that people have had to cope with negative equity. It's been a common feature of previous recessions. Now, certainly it's a problem, but it's a problem that can be worked through in many cases. Now, if someone on a 100% mortgage and the market does dip, then on paper, you should say, or even on a computer screen, if you want to put it that way, they are in negative equity. But that alone is not going to cause them to lose their property, because as long as they keep paying the mortgage payments, the lender is not going to take any notice of the fact that right now, in this snapshot in time, they're in negative equity. So in many cases, the way to get through negative equity is to batten down the hatches, keep paying the monthly payments on your mortgage, and wait for property prices to rise again. Okay, that does limit your options in terms of, well, you might want to move, but that's going to be problematic. Now, Skipton are deliberately offering 5-year rates so that mitigates the effect of a short-term dip in the market, because your mortgage payments won't alter for those 5 years, and that possibly could see out any short-term dip in property values. Now, what happens at the end of 5 years? Well, mortgage lenders routinely offer borrowers a new deal. There's nothing new about that. That happens when every mortgage deal comes to an end. Now, rates in 5 years' time could be lower or higher than they are now. The person that's, even if they're still in negative equity, they're still going to be offered a replacement deal, which could be cheaper or a bit dearer than the current one they've been on for the last 5 years. So although the spectre of negative equity is a worry, I think it's far from an insurmountable worry. Now, where the problems could come is if other mortgage lenders perceive that they're losing out if they see borrowers flocking towards Skipton. Right now, I can't see that happening, but you can't fully discount it. So what could be more worrying is if a whole swathe of lenders start coming out with competitive 100% mortgages, and the scrutiny with which it appears that the Skipton is going to put into practice, limiting the amount of people that can get these 100% loans. Well, if that scrutiny is watered down across different lenders, then we could be facing a bit more of a problem. So right now, I think it's a cautious welcome to the initiative for a limited number of reluctant tenants to make that transition into home ownership. But it's very much a case of watch this space. And I just thought it was worth jumping on with a video about that this week, because it's very topical. And having been a broker when 100% mortgages were last around, I felt I can put a bit of perspective on that. Anyway, that's this week's video. Hey, I'll be back with another property finance video next week. See you then. Thanks for watching this video. If you liked it, you're gonna love my 100% pitch-free networking events. They run every 4 months, 5 hours of solid wall-to-wall networking at a weekend, and there's not a pitch to buy training in sight. You have my guarantee on that. Click the link around this video to see when the next 100% pitch-free networking is running. I'd love to see you there.